Good afternoon. This Tuesday, December 13th, CPI data out this morning showed inflation still higher year over year by over 7%, but the uptick increases that what was estimated to occur did not happen, up just 0.3% over November. And so that kept the things in check, allowing the equity markets to explode today, along with the gold, the energies, and it gave support initially to the grains earlier in the day as U.S. dollar broke down to significant support just under 104. Well, tomorrow is the day the interest rates get risen by at minimum half a percentage rate, and they're thinking no more than that. But what the Federal Reserve Fed Chair Powell states at 1:30 is what they'll be watching for to see if they're going to lead towards a pause in raising interest rates in the new year. Let's get to look at the charts, some weather in South America, and what the markets are telling us. U.S. dollar today breaking to another new low here since peaking back in early and mid-September. But on the monthly charts, it's right back into where these valuations, we feel you're going to start seeing stability on the dollar. And with tomorrow's interest rate hike and Fed comments, we'll see if he can create the lift starting off this bounce. On the gold chart, spiking on that news this morning. We have that turn date. It was a Friday, Monday event, so we put the arrow here on yesterday. Maybe gold spiked a high if the dollar spiked a low today. Interesting thing is the consolidation over the last 2 weeks occurred at the 50% mark of the crude oil since the last major decline from our May high. But here's something real standoutish. Take a look at this. You see this horizontal orange line? That is lined up with the close of December 31st of 2021. When you look at this, here is June 30th right here. Okay, I can't draw a straight line. There's June 30th. That means the first half of the year we spent above the closing price of last year, and the last half of the year we spent below the trading close of last year. And now we're here today, challenge last December 31st close. So what's it going to be on December 31st? Are we going to show a gain on the year, or are we going to show a slight loss on the year? That's a $64,000 question, and it's December 13th, and got to get to the 31st. I will say that we're going to have some significant resistance at the 62% retracement number here of 1856. I've heard talk of possibly making it to 1920, which is a 78% Fibonacci retracement, but that would take quite the statements out of the Federal Reserve tomorrow and a failure to really raise rates. So we'll see. This is the marker from last December 31st. The question is, how far above or below are we going to close on December 31st on gold, making it just a neutral asset? Well, weather, let's go to South America. Rains did come into the northeastern portions of Argentina over the weekend. That's what caused the big drop. This is our forecast now through the 7-day out through next Tuesday. And of course, note Buenos Aires, mostly dry. Here, Cordoba, mostly dry, and obviously Santa Fe dry this weekend. They go up into the hundreds. But if we take it out to Christmas Eve day, you start to see Cordoba picking up some rain. Even Santa Fe, the southern half, grabs some. And there's a shot here through Buenos Aires. So is this building farther out? This is our 10-day model. Once you go 11 and 15 day, they get quite inaccurate. But maybe this is starting to progress forward and bring some moisture in. But for now, it's allowed the soybeans to rebound. We had that $2 two-day hit here on beans. We showed this in the newsletter, said likely to find support above $14.50. I think I even stated in the newsletter we will likely see a turnaround Tuesday. We did. The close today is just under last Thursday and Friday's closes. If we go to our alternate count, you can see it here more explicitly. Look at this recovery. Now, interesting how we find this just under the $15 mark. You got these resistance points that are stalling the market. The next two major points, this is $15.10, $15.12. So if we did bolt through $15, look for $15.10, $15.12 to be initial resistance. But if we measure this stuff out, A, B, C would imply 1573. I think we're running out of time for that. Wouldn't be shocked if we got something to challenge these or bolt through them just a little bit, something towards 1535. That's why we have a cash sale recommendation there. This week is a culmination of 90 and 180-day cycles. Here's the high. 90 days later is this high. 90 days later would be tomorrow, but you can be off a few days. So I'd say this week yet has time to potentially push. Once we start falling through what we know is support. This green line, that's the 77-day moving average, and here's the 200-day moving average, purple. I mean, this whole thing is done. This wave 2, wave C is confirmed done, whatever it is, once we fall through the green line and, more importantly, close under the 200-day moving average. Then it says we are entering the wave 5 decline into the spring. The corn chart, we had predicted that wave 1 likely bottomed at 635. We had our 5 waves down from our fall top. Yes, we called it a fall top. Everybody was looking for higher. We were looking for lower. Well, now we're getting bounces. We're looking for an A, B, C wave rally to culminate a wave 2 here. Looks like A topped out today, well shy of potential resistance at 666, turned lower today after hitting 660. Now we're going to work the B. And when I put these in here, they're not to the time. You don't go down here and read the dates. I just put them in so you can see how the pattern is going to unfold. I mean, we could be at B within 2 days and then C in 4 days and then be done. But the point is now we have a B wave pullback, probably in that 640, 642 range for support at worst, probably more something like 645, and then we turn back up again. Ultimately, 666 to 676 should be our top side. And if you have any more grain to sell, I would move that on this rally, because then we start moving lower in a wave 3 fashion in the new year into February bears. Wheat, I'm just going to go to intraday charts. We did call wave 3 was the low at 723 when it challenged that August low. Now we're starting an ABC bounce to wave 4. Looks like we're going to come up short tagging this line. I find it interesting. This purple line always gets jammed, by a day or so. These are hourly charts. So for a day, they'll jam them just by a little bit. It didn't even get there today, and now it's already turning lower. Kansas City almost touched it again. We always seem to jam these purple lines. They don't necessarily are a simple touch. It's always some kind of jam on a 6-hour basis. Today, got close to tagging it and selling off. This could just be a simple ABC, then you get a retreat. It'll likely be in a wave structure, bounce off of that, move higher, and then fade again. But I do believe you're going to see wheat move lower into the opening of the year. From there, it'll be a chip chop, but I don't think we see any excitement over the drought in Kansas until we get closer into February and start seeing the end of germination and those weather models. Crude oil, 2-day bounce today, hammered just above $70 twice. Friday and Monday turned up. Of course, the Keystone Pipeline outage has created this, but it's not going to stay out for long. Still anticipate lower action yet. Could take us lower into the 21st, matches up with the year 2018. And then maybe we start to get a turn, a major cyclical turn at that time for a seasonal lift. As you can see on the 6-hour chart, we were always spiking this purple line, working it. Now we can't even see after touching it last time. Strength here, a little shallow. I mean, 79.65 would likely find selling, but we still think we have a little more lower action yet before it wants to turn higher. It's going to take the calendar to get us to turn better. This is Eugene Graner with Heartland Investor Capital Management. Hope you find this information useful.